Good evening, ladies and gentlemen. Today is the 3rd of November, and what a day. We had a three-way move expiry, not to be outdone by last expiry, which in itself was quite eventful. Today, we opened gap up. I had a relatively negative view from about 18,000, but I was forced to sort of manage the fact that we kept heading higher. And into that we had this massive reversal where puts blew up with huge slippage, and and then you figured, okay, the rest of the day maybe we head down and hold at the lower levels. Not to be the case. Huge short covering up move, once again completely crashing the puts, blowing up the calls. Much for risk in that direction. We head down once again and break the day's low. So it was a little bit all over the place. I should have taken my own advice in the morning and not tried to scale up size into an IV spike. But invariably, it got caught in all directions and went all over the place. And really speaking, I wouldn't say I made too many mistakes here. It was just decisions that were made at that point of time, which didn't work out so well. Like when we started getting bought back for the second time, I moved up my puts a little bit too early, got stopped out, and then after that they lost all their value. So it happens. And the only thing that I would be really happy about, and that's why I walk away with this expiry with a little bit of happiness, is that I never really let the risk get out of control. At no point was I down anywhere close to 1% of my account value. 1% was the highest that I let it go. And from there, I took risk off completely. And there was many opportunities where I could have probably got that 1% back. And in fact, one of the trades that I was considering, I would have taken if I was in a little bit of a green and not already meeting my risk appetite for the day as we headed into the last few minutes before averaging. So I'm quite happy with that behavior part, wherein I kind of took my thing, because that's kind of what I went over in my talk also. So for those of you who want to watch the Traders Carnival talk, as of now, it's not available. I think for those who paid for it, a recorded version should be available down the line. Even if I get it, I won't be able to upload it on the YouTube channel because I think copyrights belong to Money Control. So as and when I do that talk again, I'll plan a time where I give the same presentation. It talks about how a bookmaker approaches stock market and how to look at the market purely from a probabilities and outcome perspective, and how you can maintain a positive edge even if you don't have any view. Like even if, forget having non-directional view, even if you don't have an edge, there is a way to maintain a positive edge if you can control your risk and reward. And that's kind of what I was aiming to do today, as is always the case, controlling my risk in case I start bleeding, nowhere to stop the bleeding, because there will be hundreds if not thousands of expiries to come, and it doesn't have to be this fun. So also, I'm quite happy with the day. Actually, it was just a tricky expiry. This was going to happen in any scenario. I'd be disappointed if I did something that was against what I would have done any other time. In this kind of a move, in a three-way move, I would have done the exact same thing all time. So this is just one of those days that was scripted for me to lose money on a day like this. So anyway, thank you so much for watching. I hope you had a good trading session. Wish you all a very happy Deepavali, and I will catch you next on Monday. Take care. Bye.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. The time is 9:20 and I've just entered my position. The idea is we had a breakdown from here. So this head and shoulder breakdown from 18,300. From that, continued to remain weak, had a panic unwinding of a lot of longs and made this triple bottom structure kind of here. So the idea more or less is that 17,600 should act as the worst case low for this expiry. And on the upside, I would think the maximum of from what was being priced in from yesterday's open interest, 18,050, 18,100 should be the high. But at the end of the day, we might have some kind of a big short covering if we take out 18,000 because of the kind of open interest that is there at 18,000 above. Right into the morning, we've seen put writing, strong put writing at the money call unwinding at low levels, and put writing all the way till 18,100. So 18,100 would be my upside range, and on the downside, I'm going to keep it quite aggressive because relatively we have had a lot of volatility, and there's a good chance that we test lower. But realistically speaking, going by current straddle pricing, we're not even pricing in an expiry below 17,800. So first real support should come at 17,800. But in case there is some kind of a continued sell-off, as we've seen weakness in the past few weeks, then I would think realistically up till 17,600 is possible. Below that, I would not think would be possible. So right now I've taken this particular position where I'm short 17,700 put option, because I'm expecting 17,800 to act as a very good support. And I've sold the 18,100 because this is just my entry trade, and the idea here is to just benefit from fall off in super OTM options as the day plays on. Depending on what happens, depending on if or not there is some kind of a continued IV spike, I might or might not take additional credit. It has been a volatile few days, and that's why for the expiry I want to keep relatively safe. There's also SBI results coming in midway that might lead to some big issue on the bank nifty. Right now bank nifty opening just about at 40,000, so it will be interesting to see if we get rejected from here, or we take out 40,000 and see some kind of short covering. So all of those things are left to play out, and for now the only thing I'm considering is from the beginning to keep a little bit extra credit by moving my half of my calls to 18,100. So I will wait and see if I have to do that or not. We'll keep you posted. As of now, the time is 9:23. I've just taken an entry position. If nothing else happens, this position should make me a good 18,000 into close to about 10 points. So 1 point, just shy of 1.8 lakhs. So that might be the case. That might also not be the case if I wait for an IV spike and then get a good opportunity to increase my sizing and move closer and take more credit. For now though, I will not be doing anything. So we'll keep you posted. The time is 9:23. As of now, the gap up is more or less holding, and yeah, 2,500 acting as a pretty good support for Reliance as well. The rest of my positions are more or less just covered calls. I took a couple of small trades yesterday and day before. So I was traveling to meet some of my wife's family, and didn't really have many big trades, but I took some small trades as in when I was watching on my phone and as in when there was a good IV spike. So on Monday and Tuesday, all right outcome, and they were pretty volatile days, both of them. Kept my sizing low, and yeah, that was more or less the outcome from Monday and Tuesday. There couldn't be a video because I was traveling, didn't really have the time to do much. So we'll keep you posted. As of now, the time is 9:24, and yeah, I have just entered my position. Idea will be to take it a little easy until like things start making more sense, because there's huge call writing that leads to a huge threat of rejection or short covering, and there's like an imbalance in the way the option chain is structured. So that's not great. We've had a super wide range the entire week. So after a volatile week, we might as well have a volatile expiry. So preemptively sort of staying away from that volatility is not a bad idea. Because if there is no volatility that plays out, I still make a pretty decent return of little more than 0.5% on the margin used. And yeah, as of now, going by the 17,950, going by the 17,900 straddle, which there was a big build-up of yesterday, it gives us about 110 points up and down. So 17,800 and 18,000 is what that particular straddle is pricing in. But if we go at the money, yeah, at the money is also pricing in 100 points up and down. So 18,050 and 17,850 is what is being priced in by this particular straddle, which is trading at 100. So if it's trading at 100 and I'm keeping a range of 450 points with 200 points on the upside and 250 points on the downside, that should more or less give me this premium. So, and if that's the case and really nothing happens and we hold sideways for the rest of the day, there's no opportunity to take an additional credit, then towards averaging, I'll probably try to collect another 2 or 3 points, and that will be the end of it. So one more thing just to add. So people say, how are you exactly staying risk off? So let me just go over this, right? So as of now, this is my position. Of course, this is my margin used for this position. And let us say I want to increase my position. I just need to buy OTM hedges, right? If I buy OTM hedges, my margin required falls to 1/3. So I can triple my position size. So on, if I triple my position size, my max profit would just at this risk off position be 3,25,000. Currently, 1,75,000 is my max profit. So I'm not leveraging my position, even though I'm taking a super OTM position. I'm not leveraging my position. So that's why I am keeping sizing low. As far as I'm concerned, it requires for me to be very comfortable with my view, know exactly, at least have a strong enough view and a good enough setup wherein I feel like, okay, there is a good opportunity to risk more. Also, a couple of other things to note. And so I'm not at my office. I don't have access to everything. I don't have my mouse. I don't have my keyboard. So that slows me down, right? So I cannot afford to take big risks at such a time and this entire period of time, right? So the nature of volatility has been in such that my particular way of trading tends to get require over management of that trade, right? We have a big up move, quick down move, quick up move, quick down move. I'm adjusting at each point. So that kind of will need me, that will kind of make me bleed. So which is why keeping it smaller, keeping it more manageable, even if I have the margin to triple my quantity right off the bat, it's not super attractive for me to do. Okay, just one minor change made to my position. I've squared off the 17,700 puts and moved them to 17,750 just to get a little bit additional credit from my put options. I don't want to move them too aggressively to 17,800 because at this point, as we start holding towards the higher levels of the day, we're seeing a little bit of short covering in the calls. I don't particularly have to be concerned about the 17,150 call too much. But there can be some sudden expansion as we take out, as and when we take out 18,000 on the upside. As of now, a lot of intraday OI changes, huge put writing, and almost 31 million put options written, and versus only 12 million call options written. All calls below 18,000 have seen unwinding, and this writing of this 18,000 straddle, which has a little bit less than 100 points in it. So the 18,000 straddle is pricing in on the up and downside put together about 100 points. So 17,900 on the downside and 18,100. My call is placed well enough that I really don't have to be concerned about it exploding too quickly. I should get an exit at about 910, which is where I would want to exit this call in case that short covering does take place. But unlikely. So as of now, this position is quite comfortable, mostly because I'm far outranging the risk that the market is pricing in. So in case that the risk does start to play out, I will have enough time to react to it. So that is how things stand. I don't want to aggressively take too much credit from the put side beforehand and then have a sharp reversal burn me, which is why I'm doing it relatively in a safe manner. And yeah, broader market deeply in the green. There's only about 5 shares that are in the negative in the Nifty. And seeing all put together, Nifty looking quite strong, and Bank Nifty also easily holding 100 plus points over 40,000. So the question will be, if we see some kind of continued short covering come in through Bank Nifty, does SBI result really throw Bank Nifty shorts off and see further short covering? All that tricky stuff will be there, but as of now I'm positioned well enough to not be bothered by a sudden kind of move. So we're almost at about 10 o'clock and I'll keep you posted. Okay, so I've moved 1/3 of my calls down to 18,100. Idea behind this is after the gap up opening and showing a little bit of strength and showing some amount of short covering, not too much, we're seeing Bank Nifty pulling back to 40,000, and a little bit we are heading back towards the day's low. And into that, there might be a quick expansion on the put, given to what extent put options have been shorted since morning. So I have moved down 1/3 of my call options lower. I'll be moving another 1/3, another 1/3 if we start to head towards the day's low, and move all of my calls to 18,100. So that's the plan for now. My puts are far enough away, they're 200 points away, where I don't have to be too concerned of a quick expansion, but preemptively taking in a little bit more call side credit. It's been huge writing of puts, and in case that starts to see unwinding, we can see quite a drastic dip, which is why days low breaking would be a very crucial point to watch out for. Okay, what I've done is I've moved all my calls down now to 18,100, and the idea here is I'll have a stop loss of about 8. So at 8 I will square, it's quite aggressive stop loss. At 8 I will square this off and roll this higher. The reason for this is there is a bias for the market right now to be bullish. Even if you go by the 17,950 straddle and you see the pricing, there is a huge premium in the calls, even though we were just centered around 17,950. There's a huge premium in the calls because of the kind of short covering and put writing that's taking place since the morning. So because of that, potentially, if there is some kind of big reversal and we make a strong break of the day's low here, so just as it looked like we were making a lower high and once again making a lower low, I have squared off my calls and moved them lower to 18,100. So at about 8.5, I'll start squaring this off one third, and roll this higher. And yeah, for now, what is remaining in this position is a little over 10 points. And should be relatively comfortable even by going by straddle pricing of 17,950 as well as 18,000. This position should be very much comfortable. And yeah, I would prefer to have a little bit more credit when there is such a large bias that market will move mostly towards the upside. So if that bias starts to shift, then very quickly even this super OTM put option 200 points out the money can put on quickly 2-3 points. So to protect against that, I would rather have this call credit than not have it. So to keep you posted, the time is just about 10:30. We're reaching that 1 hour mark. As of now, we have held extremely flat since the opening, and broader sentiment looking to be in the green. And Bank Nifty as well, after some kind of a rejection from higher levels, is now holding above that 40,000 mark. So we had this very quick down move of 130, 140 points, actually more than that, 200 points, and then from there quickly got bought back up. So we'll keep you posted. For now, as things stand, we'll not be making too many changes unless once again we start taking out the day's high, and that will expand these calls to 8 plus, and then I'll square them up. We'll keep you posted. Also, as far as re-rating is concerned, of, for example, put options, all we need to do is hold 10-15 points below 17,950 for about 5 to 10 minutes, and that will, at that point itself, you will see big re-rating in the way options are pricing. Because even when we are centered around the 17,950, there is being a large premium in this call option, almost of about 10 points, right? With just 9 points in the money, this call is trading at 54, and this is trading at 36. So it can shift very quickly if those, since morning all kinds of longs have been built up, like buying back of calls, that's call long, going long in futures, that is long, shorting of puts, that is long. In case that starts to reverse, you'll see the same rapid unwinding. That's what I'm sort of avoiding. I'm not saying that's what is going to happen, but that's what I'm trying to avoid, that particular scenario. So right now, it makes sense for me to have more credit from my call and keep a very tight stop loss on it, rather than try and keep equal premium. Okay, the time is 9:20. One thing I've done is I've moved up my puts now to 17,850 with a very tight stop loss on this of 8.5. So I moved it up at 6.5 at that price, and my stop loss on this is also 8.5. My call stop loss is also 8.5. It's quite tight because we've held the range extensively all day, and I don't want to deal with some kind of a quick range break and huge gamma move on either of this. As far as open interest is concerned, now there's huge amount of call writing at 18,000, almost 1.2 crore plus. And as far as nearby put strike, 17,900 barely has 60 lakh. And 18,000 has about 45 lakh. So the idea is that given how things are positioned, if there is a quick move in either direction after holding so long, that the move can actually be quite big. But into the up move, I didn't really want to correct this call option, but I couldn't help it once the 17,700 put option started to go below price. 17,750 is where I was at. Started to go below 2.5 rupees. I really wouldn't have any credit from my put side to balance the fact that my call would gain. So once again, and now with this much time having elapsed, have moved up my put. This puts me just about 125 points away from the put side and 125 points away from the call side. If either of them starts to expand to about 8.5, 9, then I would assume this position would have probably gained by at least a point and a half. At that point, I will make an adjustment. Until then, not really planning on doing anything. So we'll let you know. The market looks good and strong on the upside, but we are having this eerie calm where we're not going anywhere, nothing is happening, which can, I mean, it can mean the entire expiry play out like this, but it is unlikely. We've seen, if anything, going by the past few expiries, whenever we've held very calm for a long time, we have quick moves into the afternoon, or at least the second half. So as of now, the position stays like this. If either of them starts expanding to 8.5, 9, I will start shifting by taking risk off in that position rather than coming closer to the spot. Okay, the time is almost 11:50. We've had a little bit of an IV spike into which I've increased my position. Basically, I wanted to get out of these 17,850 put options at 8.5. So it turns out my exit was also correlated with the entire market's exit. So if you just go on a 1-minute chart, I wanted to get out around here. Wanted to get out around here, but by the time I could, completely rocketed out of control, doubled in like a second, exactly 1 second, and the price I ended up paying for it was 16. So that's the kind of slippage I need to cause myself. So the thing is, in that slippage alone, I gave up about 8 points right there. So 1 second. Yeah, so I squared it off at about 16, 16.28, 16.15, and try to at the same time also enter the 17,800 put. So when that crashed a little bit, that benefited my position. But given that we are in an IV spike situation where now suddenly the calls haven't given up all of their value into the down move, but puts gained quite a bit. My idea was to buy hedges and then increase my position sizing. At this point, this is trading for 12, right? If it goes to about 15, 16 is when I will have to adjust again. And the rate of expansion of the put was extremely high the first time around, so that gave away some slippage. Something similar happens here. It will be quite annoying. So I will be squaring it off much earlier. Then I'll be exiting these at about 10, 11. And I'll also wait for liquidity and place limit orders so I don't end up paying 7, 8 rupees in slippage. As of now, my puts are 130 points away. Calls are 120 points away. I'm keeping that 250 point range. And I'm getting much better pricing for 250 points now than we would have some time back. So that being the case, we'll keep you posted. Time is 11:51, and that one act of slippage completely put me in a backseat. So, okay, some wild moves, and had to get out of the 17,850 put first, then had to get out of the 17,800 just as it started to expand over 8, 9, and then moved my put option to 17,750, and also I've moved down all of my calls to 18,000 given the kind of down move we were seeing. Now the idea is on this 18,000 call is what I'll have to be a little bit more concerned about with some kind of short covering. So if this starts to go to about 11, 12, I will square this off and roll this higher. Until then, I will more or less keep my position exactly as is, and yeah, until we head till about here again, I don't have to be too worried on the calls really exploding. Whereas on the downside, had to very quickly take off risk. Once again, the 17,800 puts, I had to buy them back at about 13 and roll down to the 17,750. So yeah, the thing is, when you have so many short puts build up so quickly, so many put options being shorted at dirt cheap prices through the entire day as the fear starts to build on the upside, then on the reversal, if there is one, there can be a very quick unwinding of those put options, and that is the worst case scenario always. So yeah, anyway, I ended up getting burnt a little bit there. Also, I'm done on my current sizing. I'm down about 1.5 points. Potentially this position can easily give me over 10 points. So as of now, I'm going to keep it exactly as is. On the upside, if this expands to 12, that will be a cue to get out. On the downside, if this expands to 12, that will be a cue to get out and manage risk in that direction. As of now, the entire position itself is gaining. We're holding at 17,900, which is more or less exactly where a lot of positions were built up yesterday. And that spread is trading for give take slightly under 80. Actually, it's gaining. It was about 75. It's gaining to 80. And 80 points up and down, no problem at all. I have about 150 points in either direction. 100 points on the upside and 150 points on the downside. So for now, the position is all right. I'll see what I have to do. I'll keep you posted. Okay, so around the 17,900 we're sort of holding, but the issue is more or less going to come from if once again we take out the day's low, there will be a huge spike on the put options. This particular was the yesterday's low which I was considering. Now if that starts to get broken, once again we'll have to square off these puts. I'm planning to square them off at about 11.12. So 11.12 I will square off these puts, roll them lower to 17,700, and then from there we will see what is the next step. As of now, it's basically, for my strategy, this kind of day is the worst. Like if from the beginning we're going down, that's fine. We go up initially, continue to hold there for half the day, and then from there see a steep sell off, and that's going to always be a problem, which is exactly what is happening now. Just as we start to test the day's low and we have broken the day's low, there's a expansion on these puts, but they're not that much in a rush to cover. I'm also looking at the 17,800 put option, how that is being priced, in the 17,850. Once we basically breach 17,850, once that goes at the money, that's when I'll have to be extremely concerned about this put. I will square it off and roll it lower. I'll keep you posted. The time is 12:30. We're exactly at the halfway point, and yeah, it has definitely been on the tricky side today, as has been the case with every expiry lately. Okay, so another slide and another time of getting stopped out on the puts, and had to roll down both the puts and the calls, and now huge call writing at 17,900, 17,950, and quite a large amount of call side open interest that is now built at 17,900, and there's call writing all the way to 17,800. So now opening up potentially 17,800 as a potential spot for expiry. Had to square off my puts at 17,750, squared them off more or less at the price that I would have liked to, which was about 11 and 12. We slightly on the higher side. The rate of expansion was quite high, but about 12, and rolled it lower. At the same time, also squared off my 18,000 calls and rolled them to 17,950. Now in all of this charade and the down move, you see actually my mark to market is down just by 3 points because of how I've been reacting well in time. And what happens is, okay, I get one more roll down to 17,650, and at that point I'm just sitting on long put options. So in case there's big momentum, potentially if my trade of 17,650 also gets squared off, then I'll actually have a long put option trade into the momentum, where if this explodes, I can actually profit quite a bit from that. And yeah, we'll have to trail a stop loss on those at that point of time. Currently, once again, back to sitting on a position where the credit that is available to me is about a little bit more than 6 points after you remove the hedges, because hedges are costing almost 2 rupees now. And there's about 12 rupees in the position, in this triangle position itself. Call options hedges obviously will gain in value because people will buy OTM calls to heavily short calls at lower levels. And right now with 1 hour 45 minutes to go for averaging, I think this is comfortable. And I have another, once again, I'm always trying to keep this ratio of I have 125 points from the downside and 125 points from the upside. And getting out in time sort of helps you stay in the trade. So I'll keep you posted. As of now, it's 1:15. We've continued to see tremendous weakness. Now Bank Nifty below 39,500. In the morning we were at 40,200. Now below 39,500. It might act as a support this particular level, but at this point I wouldn't be too surprised if we see a repeat of last time's expiry. And yeah, everything is weak. Reliance is weak, IT is weak, everything is weak at this point of time. So more or less this put option I'll be squaring off at about 9.5, 10, and rolling down to 17,650 in case we continue to slide on the downside. Okay, tried something, didn't go exactly according to plan. Basically my idea was into what looked like, so into this candle, which looked like potentially some amount of strength because the whole market was moving at once. I tried to move up my put options from 17,700 to 17,750, roughly at the price of 11.12, and with a 2-point stop loss. As soon as it started going against me, I started exiting. So at about 14.5, 15, 14.5, so roughly 3 or 4 points given up there. I quickly squared that off because it wasn't going in my favor, and rolled them back down to 17,700. My calls are now all at 17,900, where there is a large amount of open interest, 70 lakh at this point of time. So my stop loss here is about 1213. So 1213 is the point at which, because it has to be a little bit higher only, that's almost 5 points on something that's trading for 8 points. The reason for that is we've looked weak, and so far it looks like the bears are winning out. So might as well side with them a little bit. And the idea will be, okay, currently I'm down 2.2. This position can fall off a good 3.7. So it's very much in control as far as mark to market is concerned. Currently I'm down about 5 points exactly, and potentially I can gain from where I am currently, if at least the second part is not as bad as the first part. I can gain a good 12 to 13 points. So that's the plan. We'll keep you posted. Time is 1:30. We've got 1.5 hours to go for averaging, and as we head into averaging, it has been a very weak day. The thing is very difficult to undo all of the damage that was done very quickly. Even if Bank Nifty makes an up move, a strong up move, and there's no support from the rest of the market like Reliance and IT, Nifty itself 17,900 should be difficult to take out. So that's more or less the position at this point of time. We'll keep you posted. I had to also roll down my hedges to 18,100. Call option hedges are very, very, very expensive. So the net credit that I can get from my call leg, despite there being a 200-point difference here, is the same as the net credit that I'm getting from my put side, where there is only a 100-point difference between the strikes. I'll keep you posted. 1.5 hours to go for averaging. As of now, I'm going to keep this position exactly as is until either of them expands to about 1213. This triangle itself is trading for about 14, so 1213 is the point at which I will take a risk off, and yeah, we'll keep you posted. Okay, so into what looked like the formation of a bottom here, into this candle, I have squared off my 17,900 call option. That is too close for comfort with the potential explosion. I squared it off about the same price at roughly about 9, and have sold the 17,950 call option, and yeah, basically got burnt both sides. When I tried to play the bounce from the bottom, I got very quickly stopped out on the put side, and now that same put option has crashed to 6. That is, I exited at 15, and yeah, into the reversal, the call option as well, squared it off just about 10 and rolled it up. So it's kind of not been my day in terms of being able to get in and out of positions. Also and done, still though, my position is just 4 points down, because the one advantage of managing risk too preemptively is that you might get stopped out many times, but the other advantage of it is that it might work out in such a fashion that that day there's a tremendous move, as has been the case today, and you'll still get away more or less without giving up too much. Now at this point, the point with which I will be right now I'll be taking only risk off. I'm not gonna move my puts up further and all that. The only thing I will do is probably square these calls off at around 7 and roll them higher, and yeah, that is the plan. Into averaging, I'll see if I can pick up 1 or 2 points, and more or less for now I would think that I'm not going to try to do anything else. I'm not going to try to playing the buying back to 17,900. That can work out really badly if it goes the other way. So I mean, all you can do is look at currently 17,900 call option open interest, and that should tell you there should be a good amount of resistance there, which is why I would think it's unlikely that this explode all the way to 7. But right as put options have crashed to the extent that they have, this went in a matter of 2 minutes from 1314 to 5. I have no intention of taking any additional credit. It'll just be taking risk off as the day plays out. So we'll keep you posted. For now, sitting on a negative of 150, and yeah, we'll let you know how things go. Okay, today is the kind of day which is just a complete pain, because now after the initial dip and complete crash on the calls, now there is a short covering. We're making an up move, a very stiff up move, coming mainly from Bank Nifty, and IT also slightly part taking in that, which is pulling us to 17,900, and these calls started to explode 17,950, so I had to square them off and move them up to 18,000. And once again, the stop loss will be the same. If this heads to 7, square this off, move it up to 18,050, and yeah, we'll also be taking some additional put credit now. Okay, with about 6 minutes to go for averaging, the current position I am on is the 17,700 and 17,900 200 points triangle with 2 points in it basically, and 1 point in my hedges, so 1 point potentially. The reason I'm not closer, I've been watching 17,750 and 17,850 since it was trading at about 12-13. But the reason I'm not closer is because my risk appetite for the day has already been met. I'm taking a 1% stop loss on an account level. And yeah, it's been a tricky day, and on that particular, in that situation, I should not be looking at taking additional risk, but rather cutting my risk as and when it starts to materialize. So at this point, with 5 minutes to go for averaging, most likely this is to go to 0, and into averaging, if I'm able to take additional credit, I will. So I'll wait for the opportunity once the averaging period has started to try and take any additional credit. It's been super tricky. This kind of day is almost like tailor-made to backfire for my trading style. So I guess there was really no alternative but to give that 1% kind of a stop loss. I will potentially gain back a little bit from this position, but definitely a day which, I mean, I tried my best to manage. There was a lot of slippage, this, that, whatnot, and that's cost of doing business. You can't really complain about it. Generally, the idea is to outperform all your charges and slippage and still come out profitable. But today that was far too difficult to do. It was not easy, and there's a reason I'm not moving down my calls to 17,850 as we continue to head higher even when these puts expand. Because there's a good chance that we see a big move. So I don't want to be anywhere 50 points close to the spot. After having such a volatile expiry, there's a very chance that the volatility continues to the very last second of averaging. So I want to also, based on that, keep my space. So yeah, all that considered, will let you know how things go. And I'm considering a positional trade wherein the idea is to use 15 to 20% of my margin available to a positional trade, which is fully hedged, that can benefit in this kind of a market. Okay, so into averaging, I first moved up my puts to 17,750, and at about 3 rupees 50 paisa, I moved my calls down to 17,850. The idea is very simple. Into averaging, this particular put option trading at 19 should go to 0 if this call option has to go in the money. So that more or less should give me a little bit of a, into averaging, most of the time it's going to go in my favor as far as probability is concerned. So I entered this position at about 4 points. It's trading at 3. My stop loss is on it at 6. It can potentially go to 0. So idea is that into averaging, we still continue to head higher, and it's only been 10 minutes. So if we really do make a big move, then I might most likely get stopped out. And if I am getting stopped out, it would be at that 1% on account value kind of a stop loss. But I wouldn't be too quick to try and get out until that stop loss is hit properly. And yeah, I can't roll my put any further up because then one of them has to be in the money, and that is going to be painful to deal with. But yeah, into averaging, as in when there is a slight opportunity, I've entered this position. The spot itself is heading to 17,850, which it will then keep pulling up the average, and this put is now crashing. So at about 5.56, I will be taking the exit on this, and that'll be the end of the day. For context as to why this is a good, relatively fair trade, is because if you see in the last 10 minutes, right, we made this big candle. So the average at all points was here, 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 here. The entire average needs to go above 17,850, and that's not going to be easy. That's not going to be as easy as somebody would think. This entire 11 rupees has to go to 0, and even if you consider the average price in the first 11 minutes of averaging is about let's say 17,840, right? That would be the average going by the pricing of these two options. Then to pull it over 17,850, we need to hold the next 15 minutes at least above 17,860. As long as the spot continues to be below 17,850, this call option is not going to have value, even if towards the end we make a 10-15 point up move, which is why I'm in this particular trade, which most of the time will work out better. If I take a stop loss, yes, that will happen once in a while. I will end up getting pushed out, but yeah, most likely to go to zero. We'll keep you posted. Spot is holding just under the strike, which is fine for me. The average will continue to remain under 17,850. Very tiring day. And just like that, I mean, first sign of a red candle and the call has given up all its value. So now my stop loss on it would be, this position is trading at 150, stop loss would be at 3. Why is the stop loss a little bit aggressive? Because few moves here and there might move temporarily, a few options, but now more or less we can consider. Now the average has gone down to 17,830. So yeah, there's no way this call option retains any value. So more or less that's going to be the end of the day. Finally going to end up closing about, this position will lose another 1 rupee, so about 30,000 from there. So roughly we'll close somewhere around 2 lakhs, 2,90,000 negative. You can say 3 lakhs negative. Today was not a day I would have made money. I mean, if it was like last expiry where the fall was quite drastic, then that's fine. At least you don't have this. And into this, I'm forced to manage risk on the calls. What else am I going to do unless I decide to kill the trade right there? And then a reversal breaking the day's low heading all the way here. This was always going to lose me money. Three-way move will always end up losing me money. And the idea is that I kind of kept it in a way that I'm not giving up more than, I mean, no point was my mark to market worse than 1% down. And towards the end, I'll be closing probably like a little more than 0.5% down. That's good enough. And one more thing is I did not take additional risk once like I started going into the negative, because at that point, I'm pretty much going to be screwed if I take additional risk on top of what I've already lost and then get burned. So as long as I control how much I lose, it should be all right. Okay, I mean, it's rare occasions that you see into averaging that one particular option expands all the way till 5 and then the other one potentially has a chance to expand as well, because this went to 3 as of now. Once again, I mean, if you look at the average, it's exactly 17,825. This either has to go to 50 or this has to go to 50 before either of these options gain value. So whoever covered this right now at 3 just a second ago, be feeling a little bit odd, because it's, I don't know, it's not the best time to cover. And yeah, as of now, position continues to have about 1 rupee in it minus the hedges. Okay, so we've closed for the day. I'm closing 3 lakhs in the negative. I'm getting a little bit of negative from the IRCTC shares that I purchased, and I ended up carrying a put diagonal somehow, because my idea was to take a double diagonal. And what ended up happening is that because of my open positions and the long options, once again, I tried to like remove them, but I couldn't clear up the margin required in time to be able to take the other side of the diagonal. So now basically I'm carrying a put diagonal, which is fine. It's not so bad, because if we do have a gap down with spike in IV, then this position will actually benefit. And if we do have some kind of a big gap up also, that's fine. I'll be able to manage it. It's small enough quantity that it will be more or less insignificant. So yeah, couldn't enter that particular position. Wanted to carry a double diagonal, which was basically shorting this particular double diagonal. Wanted to short the 17,500 and 18,100 and buy the monthly options of 17,300 and 18,300. That would have given me a good break-even range. And yeah, regardless, thank you so much for watching. I think I'm more or less happy with how I managed the day, and I really couldn't have done too much else. I had to take in additional put side credit into the up move. Maybe had I done a little bit earlier, would have worked out better. I mean, that's not something I can say is a mistake, because I have to do something to manage my bleeding calls. And once again, into the reversal, I had to once again move down my calls and then get burnt on the reversal. It was all over the place. Like, this was bound to happen. Can't do too much. This is just one of those expiries which was not meant for me, but I'm giving up a little more than 0.5%, and I'm happy with that outcome. Thank you so much for watching. Wish you all a very happy Deepavali, and I will catch you next on Monday. Take care. Bye-bye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.